proof of work and DeFi report, but this time, Michael, you got a cap, and I need one of these caps.
Appreciate it. Yeah, no, it's great to be back, Shiv. We got some swag for the first time. The DeFi report officially has some hats now, thanks to my girlfriend.
That's awesome, man. Like, when are you posting me one?
Very soon. How about a week or so? Give me a week. We'll
Awesome.
get her on the
Awesome.
case.
Awesome. I look forward to that. Yeah, it's a great looking cap. I look forward to more DeFi report merches as well, man. I think it's a good brand, and what you write is amazing. And I guess today the episode is the deep dive on Ethereum that we're going to do. And you've created an amazing Ethereum investment framework, doing some deep dive on chain analysis. I'm keen to get your take on it. And that's why I thank you that you have come again for another episode for this. And I'm not going to talk much about it. I'll let you do the talking, but I got a lot of questions about this Ethereum investment framework that you've created. Very comprehensive. I've read it and I've given you off the record my views about it, but it's mostly positive. It's almost all positive. You've written this from a first principles perspective, and I'm keen to understand that what inspired you to do this bottoms up data driven approach to analyzing Ethereum and crypto networks.
It's yeah, that's a great question. It's a long story. I'll try to make it as short as possible. But I think, going back to like the beginnings of my career and spending, 12 years doing accounting and finance, I think when I first started to study public blockchains, the real breakthrough for me was seeing them as full shared ledgers. And my accounting brain, as somebody who understands accounting and reconciliation and all the challenges with that, it immediately clicked with me that if you have this shared, secure global ledger that everybody can utilize, that's a really, really big deal for the internet. So that's kind of where it started. As I started to explore public blockchains and all this innovation, that's kind of turning point was when we had some data providers coming out, and you could start to glean some insights from what was happening on chain, because these are public networks. The data is out there, it's available, it's fully transparent. So you have providers like Token Terminal and Glassnode that I work with, and I can get some really deep insights onto what's happening on chain, which then starts to inform a thesis around what is the ultimate direction of all of these public blockchains, these protocols that are built on top of them, which ones are starting to accrue network effects, what does that mean long term, and so I think we're at like a really critical juncture right now in terms of like the sort of deployment phase of public blockchains. And there's a fantastic book called Technical Revolutions in Financial Capital that I recommend people check out. Carlotta Perez has gone through this essentially every major technical innovation throughout history, and they all follow a very similar pattern. And so I think we are at the cusp of sort of moving into the deployment phase for public blockchains, and we can get into some of that. And as I've done this sort of analysis, it's become quite clear to me that Ethereum has really, really, really strong network effects. And we'll get into some of that in this conversation. But that's really what's kind of sparked the reason that I created the Ethereum Investment Framework. Yeah.
As you know, we're currently in the midst of the crypto winter, Bitcoin halving next year, but still at the moment, we're still have got some sideline movements with crypto. What made now the right time to write and release this investment framework report that you've created?
Yeah, so this might be a good time. I'm going to pull up my slide here. Okay, so why now? I think that's a fantastic question, Shiv. Like, why now? Why is this the right time? Why am I releasing this Ethereum investment framework at this current juncture? And there's a lot of factors that are playing into that. A few of them I had just mentioned, this book, Technical Revolutions in Financial Capital. I've read it multiple times. I highly recommend people read it. There's almost like this eerie sort of alignment with what she talks about with every other past major innovation and what I'm observing happening within blockchains, crypto. The parallels are just uncanny to what I'm seeing. And in this framework that Carlotta Perez lays out in her book, there's phases to the introduction of really disruptive technologies.
Sure.
And we are currently going through sort of the second phase. It kind of kicks off with sort of like a frenzy. And I would say that the frenzy on public blockchains started in the 2016, 2017 era when we had the ICO boom on
Yeah.
Ethereum. And then you had a number of other layer one blockchains and other ecosystems that were spawned kind of from this period between, I would say, 2017 all the way through, I would say, 2021.
Yeah.
And that's kind of the frenzy phase. Typically during that phase, you
Good.
have financial capital that comes into a new technology as well. And typically the market just like completely overshoots the actual development of the technology in those early years. And this is exactly what we've seen on within the blockchain space. So, I think there's a great quote from Bill Gates where he mentions, people typically overestimate what can be done in 2 years and
Yeah.
completely underestimate what can get done in 10 years, right? And so you see like these, like, you see this in crypto where there's like this new app comes out, or there's like this new breakthrough, and the market like completely overshoots that, right? We start to price things just completely detached from reality. And then you tend to get you have a lot of leverage in the system. You tend to get a collapse after that. And so like this has been playing out in crypto, but it's actually played out in every single past innovation as well. So I
Sure.
think that's critical to understand. And we are sort of like coming out of this phase in crypto. And one of the signals of this is what we saw during 2022, which
Good.
is the sort of cleansing of the space. And again, this has happened every past innovation where
Yeah.
you sort of see the frauds are revealed, and you start to see you start to see this kind of wipe out, the leverage is wiped out, the space is cleansed out, and then policymakers and regulators step in.
Sure.
And what are we starting to see?
Mm.
We're starting to see, we have this Ripple court case that went through, and now that I believe that's a forcing function for Congress to step in and then create new rules and regulations, protect investors, allow entrepreneurs to have clear rules on what they can build. As that starts to play out, you get this like shared consensus about what is the way forward. So I
Yeah.
think we are nearing that moment. We're seeing regulation pass in Europe. We're seeing it all around the world. I think the US is coming. We're sort of a laggard there, but I think it's coming. So that's another factor playing into this. We had the BlackRock ETF, that they've applied for, that hasn't been approved yet, but it's another signal in the market of like we're nearing this sort of tipping point. And then when you look at just like the Ethereum ecosystem itself, what I'm seeing is just execution on the roadmap, right? When you look at like what's happening with the merge, which is like I think a lot of people will say is one of the most important breakthroughs in open source computing history.
I would agree to that.
To be able to merge the consensus from proof of work to proof of stake without missing a block. It's almost like building an engine or rebuilding an engine of a plane while it's in mid-flight. So the ability to execute on this roadmap, we're seeing layer 2 scaling solutions come into the space as well. We're seeing privacy being introduced on public blockchains. So all of these factors are sort of playing into this. And then when you start to look at Ethereum itself and you compare that ecosystem to the other layer 1 projects, you can start to like parse out like what's really going on here. Is there a network effect that has already sort of taken hold that is going to be really, really hard for a competing network to overcome? So I'll pause there. That was a mouthful, but that's kind
Right.
of some of the factors into like the why now piece of this.
Got it. So look, I need to go back to I used to maintain a blog once. This is way back, I think so a couple of years ago. You said something that reminded me of something that I wrote. And I'm just going to quickly go there and search for that, hoping that I can find that blog. Just give me a sec. Go to blog. I'm so glad that we've got an editor.
Yeah, it's huge. It's huge. It takes all the pressure off, right?
I know, right? Okay, got it. I wrote this actually. Wow, so I wrote this on 21st of July, 2021, and I'll not read out the entire blog, but basically the title of that was "Nothing Important Has Ever Been Built Without Irrational Exuberance." And there's an old story about the Wright brothers who built and flew their first powered airplane at Kitty Hawk on December 17, 1903. Before taking off, they asked each other how it would feel about flying for 10 seconds or a minute. One brother said that if he just had a few more days to practice before takeoff, he was confident that he'd be able to stay up in the air for an hour or more. It took off anyway, and the rest is history. So yeah, like, it's easy to understand the sense of uncertainty that governed the Wright brothers' lives. They had no way to test their imaginary plane on Earth. They could only fly it for short distances by taking off from a ship into a stiff wind, and then they could only stay aloft for short times. But yeah, like, one of the most critical education that I took out from it was that nothing important has ever been built without irrational exuberance. And that was the same thing in the 2000 dot-com bubble, when everybody was saying, the internet, like, that was irrational exuberance in the 2001 NASDAQ stock market. But we know now how influential that period was in shaping up the internet that we know of now. Yeah, I totally agree with you that, this whole irrational exuberance and then the cleansing that happens, it's a natural evolution, which is nothing new when you look at the history of human innovation. It's just another medium, which is in the form of cryptocurrency, that we are experiencing this again as a pattern.
Yeah, I couldn't agree more. That's a great. I love what you wrote there, because this is one of the really important things to me for anybody who's looking at getting involved with crypto, or like me, from as like an analyst perspective. Like, understanding history on this is incredibly important. Like, history repeats because of human behavior, right? So when we go through history, we introduce new technologies and everything changes around us, but the core principles don't change because of human behavior. There's no technology upgrade to human behavior, right?
Yeah.
That stays the same, but everything else is upgrading, and so
That's
you
true.
tend to get the same behaviors.
I love the word you said out there. There is no
Yeah,
technology upgrade to human behavior. It's so
exactly.
true.
Yeah. And I love what you said there with the irrational exuberance, Shiv, because I think people tend to look at bubbles as if like a bubble's like a bad thing.
Yeah,
And what actually people should be looking at bubbles and saying, okay, something really important is happening here. Yes, the market is probably overshooting it in the short term, but that doesn't mean the market is overshooting it in the long term, right?
exactly.
And that's coming back to that Bill Gates quote, where yes, most people will correctly identify that something really important is happening, but they'll overshoot it in the short run. And so we sort of overestimate what can happen in 2 years and underestimate over a longer period, like 10 years. But this is the sort of framework that Carlotta Perez lays out in her book. And in my view, we went through this eruption and frenzy phase, and this is really the 2016 to 2021 period right now. That's how I view it, at least. And we are starting to enter this turning point period. And the signals for that are that Congress in the United States is getting very involved with this space. We've seen these cases go to court. And as this starts to happen, we get new laws, we get regulations, and the market starts to coalesce around the shared view of where the future state is going. As that plays out, you hit an S curve. This is where the S curve happens, coming out of regulation. Right. And so this, to me, is one of the reasons that this is really like important to understand. And this is played out repeatedly with almost every technology. And it's like I said, it's almost eerie, studying these concepts and then applying them to what you see happening today with crypto.
So just playing the devil's advocate over here, to address the why now, you think that the reason why this report and the release of this report is important now is because crypto as an industry is maturing, but we know that because the crypto industry of 2017 was more matured than the crypto industry of 2013. So as a result of the evolution that we see in innovation that we've spoken about, crypto industry of 2022-2023 is more mature than the crypto industry of 2017-2018. However, correct me if I'm wrong, the message that you're pointing out is that the maturity of the industry that we are progressing towards now is enough to be considered a turning point for the industry, that it could be considered as a legitimate business with very few skeptics anymore who would consider these instruments as Ponzi schemes. Like, what you're saying is that maybe after next year, and once BlackRock comes in and Congress creates these frameworks, there would be an end of debate that Bitcoin or Ethereum are Ponzi assets.
Yes, that's nearing. We're not there. And that's why, to me, that's why this is so important to have this discussion now, because I would say the market consensus is not that today.
Yeah.
But if you go to first principles
Yes.
and you look at all of this stuff and you look at the fact that Ernst & Young is 100%
Exactly.
committed to the Ethereum network, and and what that means, then you can see that, okay, that you can see a wave coming, and
Yeah.
if you go, and we can go into this later, there are many institutions and enterprises that have focused on private blockchains to date. They are offsides, and we can get into that, but they're going to realize they're offsides after this regulatory clarity starts to come, and that's where the S curve starts to happen. And so we're probably a year or two outside of that right now, and that's why this period is so important.
So for people out there who still think that, Bitcoin, Ethereum is a Ponzi scheme, and, one of the most common retaliation that they say is that there is no cash flow, like there are no quantitative ways to measure the value of Ethereum blockchain. And I know that you dig deep to on-chain analysis, and you've covered this within the investment framework as well. Can you quickly pull up those pages of the investment framework to showcase people that, yes, you can quantitatively measure Ethereum because it does generate fees and cash flow as well. So would love for you to walk us through that section of Ethereum for us, Michael.
100%. Yeah. And thanks again for the question. So I'll just pull up. This is just, a very simple view of like the on-chain financials for Ethereum. And you're right. Like I still see people in the market saying that, you can't quantify these things because we don't have cash flows. It's not a correct statement to hear that, because I'm looking at the data online on chain, and yeah, this is just a very simple view of like what's happening on chain. So that top line, the total revenue, that is user transaction fees, right? So in Q1 of 23, Ethereum produced about $464 million of user transaction fees on chain. That number jumped up in Q2 of 23 to $846 million, right? So this is really critical for people to realize, like there's just a lot of people that are using the chain, and they're paying for computational resources to do that. And that's the product that Ethereum sells, is computational resources. People call that block space as well, but that's the product that's being sold by the Ethereum network. Now, the business model is different because those fees are being paid to a distributed set of service providers that are running the software to secure the Ethereum network, and are also recording all of the economic activity to maintain that global ledger, right? So they're being paid to do that, and those user fees are supporting the work that they do. When you start to think of like, okay, what are the expenses of this network? One way to think about that is these service providers, these people that are running the validators all over the world, that is sort of an expense to the network, right? So when a user pays a transaction fee, they're paying some of that fee to these validators, but also the network is paying the validators through inflation of the Ethereum token, right? So there's a sort of a subsidy to incentivize a global network of people to run that software. And the way that the Ethereum token economics work is that you have this like automatic buyback feature, where as the system is being used more and more of that user fee is being burned, right? Some of it is accruing to the validators, but the network actually burns some of that fee to offset the block subsidy inflation, right? And so this is like really important for people to think through from a token economic perspective. But what the Ethereum network is now showing, and we've seen this for the first 2 quarters of 2023, is that as a network is used, it's actually burning more tokens than issuing through those block subsidies to the validators. So you actually have a deflating token supply, which anybody knows, if you reduce the supply of a circulating asset, you have to increase the value of it. And so, Warren Buffett loves stock buybacks for this reason. And the Ethereum network essentially has a stock buyback program that increases as the network becomes more popular, which is a very fascinating sort of idea to explore.
So look, I've got my own views about Ethereum as a monetary asset. But I remember when Ethereum moved to proof of stake and they had this burning mechanism incorporated, that there were people that came up and started calling Ethereum ultrasound money. You remember that?
Right.
Because of the burning mechanism,
right? Because it looks like when the network moved from proof of work to proof of stake, that they basically reduced the amount of new supply. The block subsidy was reduced by almost 87%, and so when you look at that, it's almost like 3 Bitcoin halvings at once, and that's kind of where that ultrasound money meme came from. But yeah, I just pulled up also just
Yeah.
aside from like the financials, because Ethereum's an open network, other public blockchains are open networks. You have like this really, really rich data that analysts can look at and see like what's happening in terms of like monthly developers, what's happening in terms of like the amount of value that is sitting within smart contracts, within DeFi, how much gas consumption, that's the consumption of the network, what does that look like from cycle to cycle? So I've done a lot of analysis just looking at, okay, the price behavior is one thing to look at, but we can also compare that to all of these like core operating and network KPIs and run correlation analysis to like, oh, okay, like as the number of developers increases, the amount of venture capital increases, the amount of users increases, what does that mean to the price of the
Yeah.
Ethereum token? So that's some of the analysis that we put into the framework as well. Yeah.
I know this episode is more on the deep dive of Ethereum and why it has got some investment merits.
Yeah.
But just coming back to the point that we just addressed, that Bitcoin being the number one cryptocurrency out there and Ethereum being the number two because of its smart contract features, BlackRock, with the hordes of investment analysts and researchers they've got and so much of influence and money they've got, they would not file an ETF application for a Ponzi asset. Like,
right.
That should just be a giveaway. Like, for all those other individuals all over the world who still think Bitcoin is a Ponzi scheme, like, you can't be BlackRock research capabilities, Sure, they were complacent and they couldn't see what Bitcoin was back when they used to make those comments about Bitcoin. But for them to admit and then now come back and file an ETF application speaks volume about that. They've done their research, they've given it time, and they've concluded that it's not a Ponzi asset. So I think that's a big endorsement right there. And I guess once that is filed, it's only a matter of time before Ethereum comes in.
I agree. And, it's okay. Like a lot of people probably still look at Bitcoin and Ethereum and they don't understand what the purpose is. And that's why I want to get into some of this. But
Yes.
and I haven't changed for people that have been following me and reading my writing. Like I haven't changed my thesis on Bitcoin.
Yeah.
I've focused on Ethereum for this initial investment framework because Ethereum is it has
Right.
different use cases. It is not playing the same game as Ethereum in my view. They are they're two different animals. And I've focused on Ethereum just because there's more cash flow there. It's easier for investors to kind of wrap their heads around that. But
Yeah.
I couldn't agree with you more that everybody is going to capitulate on this idea that these are Ponzi schemes. That is very clear to me.
Yeah. Just on that, when you spoke about it, I think this is a good opportunity for me to ask you that in your investment framework report that I read, I mean, you make a very good, compelling case for Ethereum's network effects and position as a natural monopoly. I've got my own theory, but I'm keen to get your take on why you're confident that other L1 competitors won't be able to overcome Ethereum's lead in developers, infrastructure, and standards.
Yeah, it's a great question. And there are many people that will disagree with me on this. So let's make that very clear. There's almost a religious fervor within the crypto space. And so there are many other layer one networks, as you mentioned. I've spent a lot of time just in the weeds of the data to just, to get really into the weeds and then come out of it and say, okay, what's actually going on here? So if you really kind of unpeel the onion there, what you'll see is that Ethereum controls a roughly 80% market share. And that's, I'm leaving Bitcoin. Bitcoin's off to the side of that. I'm comparing Ethereum to Solana and Avalanche and Cardano and all these other layer ones that have kind of come on. Most of those other networks were launched in the 2016, 2017, 2018 era after Ethereum. And what you tend to get with like network technologies is they do become natural monopolies. And I'm going to pull up my screen here just to get into this. Okay, so just like getting into these network effects, I think the first principle to really understand is open networks triumph closed networks. Like, I think it's helpful to think of Ethereum in the same way that somebody would think about the internet. And you can apply that to if your favorite, ecosystem is Avalanche or Solana, like those could be the internets as well. But the idea here is that we only really need one of these things. We don't need, there's many, 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 layer one blockchains, many crypto projects, but you really only need one sort of internet for crypto. And crypto is really, I think the way to think of this is you're just adding like a data layer to the internet. and we can get into that concept a little bit more. But the key thing is that open networks triumph closed networks. The internet is a system of protocols that connect 8 billion people. And when you kind of get into Metcalfe's law, what that basically states is that the value of a network is equal to the square of the connected users on that network. And so once something starts to hit escape velocity, it just gets cheaper and cheaper to use that system. You end up with a system of standards, right? The standards on Ethereum are the programming languages. They're the token standards, ERC20, ERC721. They are the developer tooling, right? It's the number of developers. It's the amount of venture capital that has chased those developers that are now building applications which have brought in users, right? Which have led to more adoption of various wallets, which is another standard, right? Connecting to the base layer standards within the tech stack. And so you can sort of see that, like, Ethereum has over 100 million non-zero wallet addresses, right? This is like double what Bitcoin has. And it's, orders of magnitude higher than any other of the competitors. So you can see that there's something deep going on. And it's because of this like really hardened infrastructure that is already in place within the network, that is what is attracting more developers there, because you have those standards, and they can come in, and there's tooling, there's an ecosystem, there's people they can talk to. So that just drives rapid innovation. And then because this is open source technology, you have this idea of composability, which is really like developers having the ability to just kind of stack computer code on top of each other, right? This is all open source. It's in the open. You solve one problem once, some other entrepreneur takes your solution and adds it onto their solution. And so you get this rapid innovation because of this idea of open source, open network. It just drives rapid innovation. So this is all playing out within Ethereum. I'm not going to say that there's only going to be one of these. Like, I actually think, and I've written about Solana, I think there is space for different architectures, right? Solana is a monolithic blockchain, so it does have a different architecture. And there may be use cases that can be applied to that architecture that aren't best suited for Ethereum. But that's like one network I would say has, a really strong community and has a network effect to itself and potentially different use cases. But that's because Solana is properly differentiated from Ethereum. So that's kind of how I would think of that. And then, typically when you go through history, the giant does emerge in the first 10 years of a new technology. And so Ethereum's been around for 8 years now. When you line that up with everything I just mentioned with the network effects, it looks pretty good. And then the other piece of this is like, we will continue to see probably other layer one blockchains, and maybe we're done with like new ones getting funded by VCs, but they will come out and they'll say, we're faster, we have cheaper, settlement
That's
finality.
what they say. Before Ethereum came and there was Bitcoin, there were all kinds of Bitcoin forks that were created that either said that, oh, you can mine more than 21 million Bitcoins, 21 million of their proof of work coins, or they used to say that you're faster. Well, you're faster because most of your nodes are centralized. And yeah, once Ethereum came in, then there was EOS that was supposed to be the Ethereum killer because it was faster. Right. Then there was Cardano, which still has got an insane following despite producing nothing of worthy for the last 6 years since their launch. Same can be said for Polkadot as well. Like, it's been a while and we still haven't seen anything of worthiness from Polkadot ecosystem as well. About your point about VC money, I mean, we know what happened with Aptos. The less I say, the better. But yeah, they marketed themselves as, a smart contract blockchain with 100,000 transactions per second. And I remember when they launched their mainnet, it was like in single digits, if I remember correctly. Nowhere near the 100,000. So yeah, you're spot on that. All these other layer one blockchains are going to come with new marketing tactics, so they are going to be faster, or new proof of stake consensus system that is more environmental friendly and more decentralized.
Yeah, and I couldn't agree more. Like, we may continue to see this, right? And I get it. Like, there are incentives for an entrepreneur. If VCs are going to throw money at these things, then you're creating an incentive structure where entrepreneurs are going to do it, right? So I don't blame people for doing that, but and many of these probably do have better technology, right? That's actually like kind of interesting to me, is like some of these actually will come out and they'll actually have better features, and they'll say, look at me, I solved this problem that couldn't be solved on Ethereum. And The truth is that good enough technology wins because of Moore's law. People will complain that Ethereum is slow and it's not scaling and it's expensive, but what they're missing is Moore's law is playing out on Ethereum, and we're seeing this with the roadmap being executed on. So now we have this. You create a problem because there's so much demand to use Ethereum, right? This is a feature, not a bug. The high prices on Ethereum are a feature, not a bug, because there's tons of demand to use that network. So that creates an incentive for entrepreneurs to come in and build solutions. On top of that, this is Moore's law playing out, right? So now we've increased the amount of block space available within the ecosystem because we now have all these layer twos. And so now that thing that you said was special, that this other layer one that you launched was special, it's actually not, because we have the scalability on Ethereum. Plus, you're connected to this vibrant ecosystem and all the other network effects and all the other users and all the other infrastructure that's on Ethereum. So once you hit escape velocity, that just compounds on itself. And the work that I've been doing is to figure out, has that already happened on Ethereum? So yeah, I will pause there. But that's sort of this is sort of how network effects play out in technology, and I think it's happening in crypto right now.
Yeah. Mm-hmm. So what role, and I would love for you to just go deep dive as to what do you think the role of layer 2 is going to be then, the Ethereum layer 2 blockchains, while Ethereum maintains decentralization, or you expect layer 2 blockchains to also be decentralized, or you think they'll be centralized and Ethereum is going to be the decentralized settlement network?
I think there's going to be a combination of all this. Let me actually pull up here what I have for layer 2s. Okay, so yeah, great question on layer 2s, and sort of the thesis that I have, and you're actually starting to see this play out a little bit. Is some of the alternative layer 1 networks. Celo is one that just did this, has now pivoted to becoming a layer 2 for Ethereum. And so just to sort of peel back for people, like layer 2s are separate blockchains that are essentially like introducing this execution layer on top of Ethereum. And Ethereum ends up being the base settlement layer that keeps track of all activity that's occurring on top of it. And so the layer 2 execution layer is essentially providing services for the user interface level, the application layer, and allowing transaction throughput to increase, lowering costs, and just allowing entrepreneurs to build things that they wouldn't have been able to build on the layer 1 because of constraints with just the scalability and the throughput of the L1. And so as you start to kind of map out, like, what does this mean for value accrual through the tech stack, the network effect, et cetera, the sort of an investment framework, I guess, that I think about here is like the layer 2 and the application layer are probably going to see less value, right? So I think actually you're going to have more value in total on these layer 1s. I have 4 here. I don't know if there's going to be 4. I think Bitcoin and Ethereum are clearly here for a very, very long time. As I mentioned, Solana is the only other one that I've actually written about and I think has some staying power. Maybe there's like another one, and then maybe you have like a longer tail that just have less value in the long run. But you're going to have probably hundreds of thousands, if not millions, of layer 2s. And those will all just anchor all their data to Ethereum. So you could have a layer 2. Like, again, I want people to think of this as like Ethereum is almost like the internet. And you can have a layer 2 that actually has geographic constraints to it, right? You could have a layer 2 that mostly services, maybe China or Korea, or there's like certain business use cases, and there's privacy, and there's KYC, AML within a layer 2. And so that layer 2 has different use cases than another one that doesn't have those features. So I think one like mental model that people can think of, if you want to kind of hone it in a little bit, is like the layer 1 is almost like, let's call it the United States, and then the layer 2s are all the states on top. So the layer 1's like the federal government, and then you have all of these states on top of it, and they have their own cultures. They have different things, and people travel to those areas or live in those areas for various features. But they're all connected to the federal government at the base layer, and so that's sort of the mental model that I see playing out here, kind of over the long run. And in terms of like value accrual, there will probably be more value on the layer 1, but that doesn't mean there's more returns on the layer 1, right? So there will probably actually be more returns on the layer 2s and the applications, because we're very early on those, right? The layer ones have pretty large pretty large market values already. I think they're going to go much, much higher, but there might be like higher returns, on the applications above the layer one.
Just on that, while you have, I think this is a good visual representation to explain the interplay between decentralized applications, layer twos and layer ones. And it reminds me of the famous FAT protocol thesis, which I think you also believe in it.
I do. Let me pull up the visual here as well. This is another really good just meta model visual for people to have. So the FAT protocol thesis is essentially saying, like, if you look at Web 2, we have these, when we think of the internet protocols, that is what everything got built on, right? So you have TCP, IP, you have HTTP, you have SMTP for email. These are like protocols that entrepreneurs built applications on top of. Now, most of the value in Web 2 accrued to the applications, right? It accrued to Microsoft and Google and Facebook, and these are the applications that just tapped into those protocols. And then by tapping in, you can reach 8 billion people globally. The difference with Web 2 is those protocols were funded by like government grants. There was we didn't have public blockchains at the time. And so there's no way for somebody to monetize the internet, right? You can't own a piece of TCP IP. There's nothing to own. So they're sort of like public goods that were funded with government dollars, with government grants, and all the value accrued to the application layer. Now with Web3, again, coming back to like Ethereum can be thought of similarly to like the internet. These are open protocols that connect 8 billion people. But the difference this time is you can own that protocol, via these crypto assets. And that's one of the, kind of breakthroughs in computer science that public blockchains enable. And that's like user controlled data is how I think of like crypto assets. You can self-custody, data. And because of this, like the value is sort of flipping to these protocols because they have massive network effects. The network effect accrues to the protocol, not the application. In Web3, the application's tapping into that protocol, but at the end of the day, the user could easily switch to a new application because they're all tapped into the same protocol. An example of this is DeFi, right? Anybody who's used DeFi knows that when you go to Uniswap, you just plug it, you sign in with your wallet, right? So what you're doing there is you're just connecting your wallet, which is you on the open protocol, to an application. If you decide that Uniswap is charging too much on their fees or you don't like the user experience, you just disconnect your wallet and then you connect it to Compound's website or maybe SushiSwap or another DEX. What you're doing there is you just switched from TD Bank to Ameritrade or something, or some other brokerage. Or you switch from Bank of America to Citibank, and by going from Compound to Aave, and that's a really powerful thing. The network effect accrues to the protocol, and the value should also accrue to the protocol because now we have crypto assets and a way to monetize these. So this is like kind of a framework that I like to talk about as well.
Sure. Look, just on that, what I'm keen to get your take on is that I'm not sure whether you're familiar with this theory that Boston Consulting Group, BCG, came up with, and it's called the Rule of Three. And what it suggests is that regardless of an industry, or you can also say it in the form of creative arts as well, in terms of creator ecosystem, whether it's actors, directors, is that given 10, 15 years of time, an industry matures enough that 3 or 4 players capture 80 to 90% of the market. So that's what the Rule of Three framework theory of Boston Consulting Group that they came up in early 1970s dictates. Given that knowledge and theory, would you say that when it comes to applying that framework towards layer one blockchain, Bitcoin, Ethereum, two of them, it's quite evident, at least for the foreseeable future, that those two will continue to remain as the top 2 layer one blockchains. And then for the other 2, if we go by the Rule of 3 and 4, we're waiting to see what it could be, Solana or others, but Bitcoin and Ethereum are there. What I'm keen to get your take on is that, do you see the same Rule of 3 to be applicable for layer 2 blockchains as well? And if yes, what are those layer 2 blockchains for Ethereum that you think have already established themselves being part of that Rule of 3?
That's super interesting. I like that. I haven't seen that framework. I like it. And yeah, so I this is my like how I'm thinking about layer twos right now is you have a few large sort of generalized layer twos, and that's like Optimism, Arbitrum, Polygon is a side chain. And, if you look at like the OP stack and what's happening there is you almost see like an ecosystem and like a launch pad for other L2s. So an example is Coinbase. They launched an L2 called
Yeah.
Base. They are leveraging the OP stack, right? So
Yeah.
that's going to be within Optimism. These concepts are still pretty early, and we're still trying to figure out the like business models and
Yeah.
how that's going to play out. How these, because these you mentioned earlier, like they're pretty centralized. The
Yeah.
sequencers are centralized. They all plan to decentralize, and everything in blockchain has to start centralized. Even Bitcoin started with just
Yeah.
one or two
True.
people mining it, and they have
Yeah.
to sort of decentralize over time.
Yeah.
And there are solutions coming to the market that are helping them to decentralize. Like there's a thing called Espresso, which is
Yeah.
helping L2s decentralize. But yeah, I think you're going to have a couple large, generalized layer twos, and then you'll have specific L2s that offer different features for different use cases. And then you'll actually also have app specific L2s. So, they'll just app specific blockchains themselves. It's one use case. They want to control the entire tech stack. I think you're going to have that as well, and those will be more centralized. But again, everything's connected to the sort of Ethereum settlement layer at the bottom of all of this.
Got it.
Yeah.
Just quickly, what do you think about Cosmos as a chain then? Because they are building on the thesis of them, and other blockchains are also there that believe that all these blockchains need to talk to each other and build an interoperable blockchain. So what is your take on Cosmos?
Yeah. So Cosmos is that roadmap to me is just colliding with Ethereum. So I see what this Cosmos ecosystem and having like a shared settlement layer and all of these various blockchains, like that to me is just playing out on L2 on
Sure.
Ethereum. So that thesis, that vision to me is like the same thing as what's going to play out on Ethereum. So then it's like, okay, is that network as secure as Ethereum? Does it have strong network
Yeah.
effects? Does the architecture really make sense?
Yeah.
Are we going to see, different applications move over there? I'm watching that. There was, DYDX did move over to the Cosmos ecosystem because they want to control the entire
Yeah.
tech stack. But I think you're going to have those opportunities on Ethereum as well. There's going to be people that build that and allow people to have full control.
Sure.
So yeah, I know it's an interesting ecosystem. There's some interesting stuff there. A lot of people are interested in Cosmos, but I sort of just think that that's going to play out in the L2 ecosystem with
Sure.
Ethereum serving as the base settlement. And
What?
maybe Ethereum serves as settlement for Cosmos apps as well.
Sure.
We'll see.
Yeah. So look, I think we've covered a lot of detailed stuff already regarding the investment framework, but I've read the full 74-page report because I wanted to give you the feedback, and I thought that it's filled with insights and on-chain data to, endorse those insights. I'm keen to know as to what was the ideal audience you had in mind when you were writing this.
Yeah, thanks for the question. I think the problem that I'm trying to solve with this is the problem that I dealt with, and I think almost everybody that's been pretty early to this space has dealt with, and that's just like finding trusted resources, trusted analysis, and like one place to go, right? So I can't tell you how many bookmarks I have of YouTube channels that I'm watching and Substacks that I'm reading and Twitter accounts that I'm following and people on LinkedIn that I follow and VC blogs that I'm reading, and then you go on Twitter and there's a lot of anonymous
Yeah.
accounts and it's hard to trust. I remember when I first got involved and I was just trying to figure out like where is there a wallet? What wallet can I trust? Because you think
Sure.
you're being scammed around every corner in
Yeah. True.
crypto, and in many cases you are. And so there's just there's a lot of like gaps you can fall into. What
Yeah.
I'm trying to do is just be a trusted resource, solve this problem, and say, hey, I'm combining 15 years of experience in business, 3 years like really deep diving crypto, using all these applications. I think one of the cool things with crypto is it's all permissionless, so you can use all these
Yeah.
things. But yeah, I'm just combining all of that, working with these data providers and putting this out there really for, it's almost like a crypto curious investor, can get a lot from this. If you invest in traditional assets and you want a framework that follows cash flows for crypto, you're going to learn something here. If you're like a registered investment advisor and your clients are asking you about crypto and you want like one document that can like really help you understand that and then articulate properly to your clients, I think this is a great resource. Venture capitalists, hedge funds, anybody who's starting to like move into this space, they need a framework. They need a high level view of what's going on, and then also get into the weeds of the network effects, the data, the financials, the cash flows, to be able to wrap their heads around what's going on here. And then content creators, educators, anybody who's trying to teach others about what's going on here, I think this is a good resource. So I think those are some of the primary candidates that will get value from the Ethereum investment framework. So that's really who I made it for. But the problem that I'm trying to solve is just to reduce the amount of time that people spend trying to get good information, and then just a trusted resource that's giving you the data behind everything that I state.
Yes, so I just want to go on record and say that this is not a paid promotion. I'm not getting paid for this. Michael is not paying me anything for this, but this is a promotion nevertheless, because Michael is a friend and I have read the report. He gave me a week ago when it was drafted, and I thought it was a great piece of work. He put in a lot of effort in it, and I told him that I've loved what you have created over here, and if there's any way that I can support it, then I would. So that's why I'm doing it. Although I wouldn't mind if you post me that cap, man.
We'll get you one of these. We'll get you one. They're coming. We'll get the store. We'll get the little web store up at some point here.
We're gonna get a Shopify store and put some Ethereum NFTs as well. Think about it.
Well, that's actually a direction I'm probably going to go with this. So for people that are interested in this, I'm creating a membership model here. So it's going to be updated on a quarterly basis. And something that I'm looking into is actually creating NFTs out of this, and actually showing like, okay, let's mint NFTs. And then you have like the original of these frameworks. But yeah, if you sign up, you're going to get a quarterly report for the next 2 years, updating the data as the ecosystem grows, as new use cases come in. You're gonna be part of that membership. So
yeah, that's amazing. Now look, this final question is for my students who WhatsApp me, send me messages avidly, asking me about views about what's happening and all. So for newcomers to the space, what are the 1 to 2 key takeaways you hope they grasp after reading your framework? And what advice would you give them on how to think about crypto as an investment? And I know this is purely for educational purposes, not a financial advice, but yeah, keen for my students to get some take from you.
It's a great question, and there's a million different angles I could go on this. I'm going to focus on, there's 2 fundamental problems to me that are being solved by blockchains. And this is, I think one of the biggest challenges people have when they stare at it and they're trying to understand, like, what is this thing? And, you could say this about the internet and many like sort of, really big concepts and trying to break things down. What are the takeaways? But to me, public blockchains are solving 2 massive problems. The first one is the lack of a global shared database. And this is kind of like the accounting side of it for me. The idea of having like a global database that's recording the economic activity of all the applications on top of it is just an incredibly powerful idea. And like, the internet is like this incredible thing. It's these open protocols that have allowed entrepreneurs to build these amazing applications on top of it that's made everybody's life so much better. And but the challenge with the internet today is that there is no shared database to record the state of all those users across time. And so we're using proprietary databases to do that, right? So if Facebook has a proprietary database, and if you do anything on Facebook, they're tracking all of your clicks, and this is happening with cookies, right? That's how we're solving this today. It's with cookies. Public blockchains completely change this, right? The internet, almost every business model of the internet is advertising today, because that is how you monetize databases, proprietary data. So when you change that and you create a database that's secure, that all these applications can build off of, and the users can control their data with digital wallets, I believe that is going to over time essentially transform every business model on the internet, because you've completely changed the data structure of the internet. So that's like the first thing, and that's pretty abstract, and we could probably have a whole podcast going into that.
Sure.
The other piece of it is the introduction of digital property rights to the internet, right? So because we don't have a shared database, users can't control their data, right? We spend all our time on the internet, we're clicking around everywhere, but we can't control that data. With crypto, we're introducing digital property rights. And this is really like the introduction of digital wallets that then control access to data, right? So if you have a wallet, you have a wallet address, and that's pointing to the crypto assets that are sitting in your wallet. You control that data. You can send that data to somebody else, and now they have the assets. So an example of this is the Ethereum Investment Framework is a PDF document. So if I send that PDF document to you, Shiv, you have the document now, but I also have the document. So we both have it. So, but let's say that's an NFT. This is the concept of digital property rights. If it's an NFT and I send you an NFT, now you have the NFT and I don't have it.
True.
So yes, you can make a copy of that NFT or whatever and copy it, but you don't have the original.
You can save as picture. I'm joking. A lot of people.
Exactly. Right click, save as. Exactly. And you can do that. But this is the concept of digital property rights. And, it's important, again, to zoom out on history. And the breakthrough of the modern economy was the ability to control land, right? So once you can control land and you have clear title to land, then people can leverage that, right? Now you can take out a loan against your land. You can start a business and you can start to financialize the economy. This same concept is going to play out on public blockchains because we can now create ownership of data on the internet. So that's Web3. People talk about this a lot. It's the introduction of ownership to the internet, and I call it digital property rights. But these are the two concepts people really need to sort of study and get into this because it's going to change the structure of the internet over a long period of time.
So I just want to quickly summarize that digital property right point, giving Michael's next work of 100 odd pages, whenever he creates the next investment framework, that he's going to drop it as an NFT. It's going to be called whatever the framework is going to be. They're going to drop NFTs, first 50 of them. And those first 50 NFT holders for that particular framework report are going to get some special capabilities for your community. Now, nobody can duplicate those 50. If you drop those 50 NFTs and the people who mint it, the first come, first spaces, first 50 people who mint it, they hold those NFT. Even if you right click save as, the joke that I said in between, I just want to point it out, it's not going to make a difference because it's stored on a public blockchain, and only those 50 individuals who got it on their wallet have the ability to secure special rights, not those people who have right clicked and saved as those NFTs. So your point about digital property rights, we can do an entire podcast episode to do a deep dive on it, to explain to people what it means and why we say that these public blockchains are of importance. And I think you did a great job within this episode to speak about that, as well as the investment merits of Ethereum. However, just a big shout out that none of this is financial advice. This is purely for educational purposes. And even the investment framework that Michael has created is not to be considered as a financial advice. It's purely for informational and educational purposes as well. So, Michael, anything else that you want to talk about regarding the investment framework?
I think that's it. I think just the takeaways for people is I created this as a document that can be clicked. I don't want people to feel like it's a book. It's it's kind of structured by sections, and you can click through each section and kind of spend some time with it, study the data, ask questions, ask me questions, reach out. I plan on making it better each quarter as well. But we're recording this on a Friday, but it's gonna go live on July 31st. And we'll put a link, in the show notes as well for that. But thanks for having me on. I love talking about this stuff. We can go much deeper into many areas of this, but thanks for having me on and asking a lot of awesome questions as usual.
It's entirely my pleasure, man. And, I'll love to have you have this discussion, and we can have a 7-hour podcast if we have the time to just do a deep dive on a whole lot of blockchain related topics. But I think this was a great follow-up to the conversation that we had last week. And it's quite worthy that Ethereum, which kind of revolutionized and is still will continue to revolutionize internet and internet-based businesses. So thanks a lot for you for creating this framework and taking out the time to discuss this on the Proof of Work podcast as well. For everybody out out there, do check out Michael's Substack, the DeFi Report. Great writing. Been a fan of his work for the last many years. This Ethereum Investment Framework, you got to definitely check it out as well. It's an impeccable piece of analytical work. 74 pages, every page full of insight. You're going to love it. And hopefully I'll get the DeFi Report cap soon as well.
We'll get you. It'll be in the mail tomorrow.